This week on Case Studies with the Biz Doc, it's Peloton, the bicycle, the subscription revenue, the great story, the ramp on Wall Street, but then the unfortunate tragedy with the product. We've got the whole thing from venture funding at the beginning to the IPO to where they are today this week. Peloton. In New York City, conceived by a New Yorker, a very interesting story. Let's start at the beginning, go through the venture funding, then to the IPO, and to some lessons and things that happened along the way. It is a very interesting story. It all starts when this guy, John Foley, was working for this company, Barnes & Noble. Foley's idea was to build this bike, this athletic equipment, and go out and give people the opportunity to work out at home. Very interesting concept. So in 2012, with $400,000 in seed, he starts. Now let's travel down here with the blue items being milestones in the company. So in 2012, he's got the idea and the team, and he starts out with the seed money, and they raised a Series A in December of 2012, $3.5 million. Now they would use all this money to build their prototype, and their prototype was pretty well received. In 2013, that prototype was put up on Kickstarter. They raised, I think, another $300,000 on Kickstarter, but the real purpose of being on Kickstarter, and here's a very interesting cheat for you, and a pro code, if you will, is Kickstarter allowed them to get exposed. So they had already had, this is almost $4 million in Series A and seed, but they gained a little bit more and a lot of recognition here. From that, they were able to attract the attention of Tiger Global. I did a case study on Tiger Global. If you want to know more about this very significant investor, you can go out and watch that case study. Tiger Global would give them $10.5 million, Tiger Global and others, but Tiger led the round, as a Series B in April of 2014. They started selling, and at that time there was a little bit of complaints. They were an early stage company. There was very long lead times to get the bikes, and they also at the same time opened up a studio in the Chelsea district of Manhattan, New York, a spin studio. So now you could go in, sit on the bike, and there's a professional leading the spinning class. And there you go. It's now selling. It's out there for you and me to buy. Lead times weren't terribly good, and the spin studio opened in Manhattan. That is what they continued to move with, the bike. Then in 2015, things were going good. And remember I talk about doubling your venture and what you need? Well, they would actually triple it, not the full 30 million Series C from Tiger, but it was Tiger and others in that Series C. There you go. Then in December, it more than doubles at 75 million. This is a key for me. 3x and then over 2x, selling, opening studios, and the notoriety is really starting to build up for Peloton and the bike that you can use online. Well, it would go so well that in May of 2017, we're talking, a year and a half from the December raise, they raised $325 million at a $1.3 billion valuation. Welcome to the Unicorn Club, Peloton. And away they go. If you go a little bit further, just a year later, in August of 2018, they would raise $550 million at a $4.2 billion valuation. So ladies and gentlemen, you're off and running. Now, what's also interesting is here's where we have information on their financial filings. And incidentally, on a 12-month basis, that's your full year. In their case, they were filing and were announcing on June 30th for the previous year. So just think of it as a full year. So the full year ending June 30th, $435 million here, and then $915 million in 2019, June of 19. June of 2020, it's $1.8 billion, and then June of 2021, it's $4 billion. So what happens here? You can see you're more than doubling your revenue here from 435. A doubling would be 870, but you're at 915. You've doubled your revenue, and you're going out for an IPO, and there's no surprise. September 26th, the IPO goes out about 23, 26 a share. You can look it up and test me on that. I think that's where it was on day one. And But take a look. That is September 26th of 2019. What happened in December of 2019? We started hearing a new word in America, and that word was Wuhan. What's going on in Wuhan, China? What is up with this virus? It's called COVID-19. What's COVID-19? Well, COVID-19 was pushing people home indoors. I can't go to my workout. And by the way, workout locations, restaurants, bars, open areas where the public would get together got hard hit immediately in the spring of 20. Shut it down, shut it down, shut it down. Well, that led to this 915 million in sales for June, the IPO in September, and then by June of the following year, it's 1.8 billion. It's a doubling. Thanks to COVID, people are getting Pelotons going inside. By the way, it's not just the bike now, it's also the Tread Plus. In 2018, the Tread Plus was announced. So now you have multiple Peloton products. You have subscription revenue and revenue, people just buy the bike, and then subscriptions online for the music and the trainers and the social aspect where you could get together with people and be working out at the same time, and fueled by COVID, where you have to go inside and your favorite 24-hour fitness was closed. And look what happens to the stock. From 26, it goes all the way up to $158 a share right about the beginning of 2021. That's a $50 billion market cap, and there's only one word for that rocket ship ride, and that is damn. That is a ride up. I almost need Elon Musk's little rocket, but I'm going to leave that off because they come back to Earth very quickly for a couple reasons. A terrible thing happened. We've seen the videos on YouTube, and the video on YouTube, fortunately, it was a child that doesn't get killed, but when that child gets pulled under, we now know exactly what happened when that other child who perished tragically got pulled underneath the tread, and there's a big recall of the Tread Plus treadmill. Now, that brings the stock all the way back down to earth where it is today, $42 a share. Well, there's a couple other things that happened along the way, because you could just look at this and say, wow, that's too bad. COVID takes it up, but then as COVID goes away and this terrible recall, they come down. Well, there's a few other things in there that I think were led to the underlying structure of the people and the company that was Peloton, that maybe they grew a little too fast and maybe they weren't as in control. This is a huge growth line here for when you're making a physical product. Your supply lines, your quality control, your shipping, your pre-orders to make sure you have enough in stock for people. Who can predict this kind of growth? And it led to long lead times for the product. But now let's take a look here. About the time of the IPO, they were sued for $150 million. And there should be an M for million on both of this. They weren't sued for $150. Here you go, write a check. They were sued for $150 million by the music industry, and the music guys are very upset because there was music that was in the background of those classes and of those workout routines that they did not have full license to. Now, the music industry is tough. The Performing Rights Organization, or PROS, I mean ASCAP, CSAC, and all these that are out there, people that know music know what I'm talking about. They are very particular. You have mechanical rights, performing rights, rights, and you have to be careful and ensure that you've got the right contracting in place to put music, whether it's in a YouTube video, and they'll pull things down immediately if you're using copyrighted music, or you have a product like Peloton and you have music in the background of your workout routines. Well, nonetheless, about the time they're going public, it was sued for $150. And as the S1 came out, I looked at the dates and it got increased to 300 million. Now, I don't know if these are related. Hey, those guys are going public. Change it to 300 million. Nonetheless, consumers were also upset because they said that the alternative music that was put on after they pulled off the music that was in violation sucked. So the really good music was under license and they got sued for it. And then they got, average music put on, and consumers were said, man, this isn't the kind of beat and kind of music that I like. This stuff's kind of Well, nonetheless, they settled and they went out for the IPO. So this really tells me something. When I see things like this, I say, was that company fully in control of its rocket ship growth, or was it like hanging onto a rope and the horse is running down the path and it's just dragging them along? The metaphor, I think you'll understand. Well, let's go take a look at it. They were also in the middle of suing Flywheel. And Flywheel later admitted, yeah, we're sorry, we illegally copied the Peloton technology. And they settled and they stopped doing that. Right now, I think Flywheel is completely out of business because I think in the last 12 months they've completely closed. Don't need to do a case study on that. They were here and gone and sued and admitted it and settled with Peloton. And Peloton also bought Precor for $420 million. Now, Precor is also an athletic equipment company for home gym use. So that makes pretty good sense. And also they got a pretty big, I think it's in North Carolina, they got like Wilmington or something is the city I think I'm thinking of. And they had a pretty big facility that they got as part of this to help them build things. So that takes us to here. So when I look at these things going on, there's a lot going on inside the company, even as COVID and you're growing and you're driving. Nonetheless, it's a pretty good story from the beginning of a guy who leaves Barnes & Noble with a dream to build this equipment, builds the equipment, gets subscription revenue, opens stores in Manhattan, had a pretty good thing going, introduces a treadmill. Then it gets a little messy here with the growth. And then we find out here that when the recall happens, there's an awful lot inside. So my lessons today come from the company themselves. When you see the pink, you know it's a Biz Doc lesson in the Biz Doc case study. And the lesson here is in their leaked audio. John Foley and the CFO, Jim Woodward, both said a few things on leaked audio. Now, there was nothing racial or crazy or over the top, but they were saying, we got to get back to basics. We're just as upset about the stock price as you are, and we think in our growth, we've become undisciplined. There it is. There it is. As you encounter growth, often you got to get back to basics, the basics of good processes, the basics of managing growth, the basics of having good management. And if you don't have them, go find them. And it's hard to do when you're on a rocket ship. You can outgrow management who is really good here, but they're not so good there. Meaning they were okay when you're making 1,000 of the Tread Pluses a month. Now you're making 9,000, 10,000, 20,000, a quarter, and suddenly they're overwhelmed. That takes someone with more experience. And sometimes that's where it is. And I think those comments about back to basics and undisciplined, that's exactly what they were talking about. So the leak audio comes out, the stock comes down, once upon a time at 158, and then analysts are out there saying, well, I only think 75, 80, 85. That was the range that the analysts are on. So even as it sits right now in December 1st of 2021, as we film this, it's sitting there at 42, which is right at their 52-week low, meaning that's the lowest they've been in a year. Well, it's easy to see that because they're currently on the downside, which is normally the fun side of a roller coaster. It's not the fun side if it's stock, although just the same screaming, yeah! But, and so this is one of those downer dams, damn. And so $13 billion here, $50 billion market cap when it was trading at $158 per share, which is an all-time high price per share. And so now you can see that it's, about 20% of the market cap it used to have in a 52-week low. And you got management saying we got to get back to basics. We were undisciplined. Well, the one good thing about the leaked audio is this. Now the market knows and the market understands, and John Foley and Jim Woodward don't have to say anything to the analysts other than, hey, we got to get back to basics. We've finished our recall. We have safer products. We're pushing the subscription revenue. We're selling the bikes in a post-COVID world. And we know the stock's at a 52-week low, but we're getting back to basics and disciplines because we're a great company. And they are a great company. What gets hidden in all this is there's some pretty reasonable subscription revenue. And if they can continue to drive that up, that's recurring revenue that makes it much easier to drive the stock price up. And by the way, I disagree with one thing. You can talk to your team and say, we're really bummed out about the stock going down, but that's it. You have to stop there because you can't just dwell on your stock going down. You have to come back and say, if we run a good business, get back to growth, get our subscription revenue, get next generation of the bikes out there and things that people love, they love our brand, we're well known. If we just do that, the stock will take care of itself. That is a lesson for public companies. And this, with the ups and downs, is the story of Peloton. What a story, but what do you think? Leave a comment down below. I'll answer as many as I can. And when you're there, please subscribe to Valuetainment, the best channel on the internet for entrepreneurial content just like this. And while you're there, hit the bell and you'll get notifications whenever there's a new case study from the Biz Doc and other great Valuetainment content. If you like this case study, by the way, maybe you like one of these from the Biz Doc archive. Until next time, I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.